The vast majority of people buy cars based on the monthly payment. It's not a question of value for money. It's just, do they actually have enough money? Can they afford it?
You just heard Elon Musk at last week's annual shareholder meeting talking about how the biggest determining factor for whether a person can afford a Tesla comes down to the monthly payment amount and whether it fits into a person's budget. As of this recording, the base monthly payment on a Tesla Model Y long range purchased today in the US is about $1,031 per month, including insurance. To put this payment into perspective, the current average monthly payment for a new car in the US is about $884 per month, and for used cars, it's about $676 per month with insurance. So a Tesla Model Y long range is about $147 higher per month than the typical new car right now, and $355 per month higher than the typical used car. And obviously that's before we start talking about the savings you get from gas and maintenance, but most people are going to be focused on this upfront car payment plus insurance. A year from now, though, it's highly possible that the monthly payment for a brand new Model Y long range could be half of what it is today, coming in right around $500 per month and well under what someone pays for a used, non-Tesla, non-EV at this moment. In today's video, I'm going to show you how there are 5 different catalysts that can make Teslas sold in the US significantly cheaper by this time next year, as much as 50% less in some cases. But the best part of all this is that I believe Tesla can do this while still selling each car with at least as much profit per car as they are achieving today, which will be a huge win for Tesla, its customers, and us as shareholders. Let's dive right in. The first and probably the most obvious catalyst is the economies of scale that will be gained at Giga Texas over the next year. As Tesla ramps up manufacturing volume of the Giga Texas Model Y and 4680 cell production, they will be able to continue passing along cost savings and price cuts to the end consumer. Recently, we just heard that Giga Texas surpassed production of 5,000 Model Ys per week. This may sound like a lot, but it's nowhere near where Giga Texas should be by this time next year. To give you some context, Giga Shanghai produces about 14,000 Model Ys per week, nearly triple that of Giga Texas. So they should gain some massive cost savings as Giga Texas reaches full production over the next year or so. Also, Tesla should be getting the full battery manufacturing tax credit in the Inflation Reduction Act on any 4680 cells that they produce. Currently, most Model Ys are produced without 4680 cells, but that is likely to change at some point in 2024. My guess is that Tesla will continue to drive down their sticker price by about $2,000 to $4,000 more than it is today, just from the cost savings they reap through scale and production with the 4680 cells at Giga Texas. The next big catalyst in 2024 will be dropping interest rates.
Interest rates have a very big effect on the affordability of cars. The vast majority of people is just, can they afford to pay the payment? As the interest rates increase and credit tightens, like it's safe to say that these various banks that have died are probably somewhat distracted from handing out auto loans.
Earlier this month, we saw the lowest inflation print we have seen in 2 years at 4.9% year over year. This reached an important milestone where the rate of inflation is now below the federal funds rate, which is usually the tipping point required to put inflation in its place. This is further supported by data from a very valuable website called Trueflation, which tends to be a month or two ahead of the Fed's lagging data. If you guys have never visited Trueflation website or don't follow them on Twitter, I highly recommend it. They are showing inflation is closer to 3% today, as most of the Fed's data, especially around housing, is lagging. All of that is to say that it's highly likely that interest rates will come down by this time next year. The current advertised APR on Tesla's website is 5.59% right now. If Tesla is able to get back down to where they were during times of normal inflation, they typically advertise a rate around 2.99%. That drop of about 3% is enough to cut off about $50 per month from the average person's monthly payment. The third big catalyst for Tesla has to do with the Inflation Reduction Act, but this time for the $7,500 EV tax credit. On January 1st of 2023, the IRA brought back that $7,500 tax credit that Tesla hadn't had access to since 2019. The problem with this credit is that it can't be taken at the point of sale. So someone who purchases a Tesla today won't be able to see the benefits of that credit until April of 2024 at the earliest, when they file their 2023 taxes. But starting in 2024, that $7,500 credit is switching to a point of sale credit, meaning that Tesla can actually advertise their vehicles as $7,500 cheaper than they are today, and anybody who finances a vehicle will be able to take out a loan that is $7,500 less than it is today. This is key because so many people who make big purchases like cars cars and houses pay way more attention to the monthly payment amount than the full amount of the loan, as evidenced by Elon's quote at the beginning of this video. Monthly payments are just way more concrete and easy for people to budget for. For most Tesla purchases, this EV tax credit takes the average cost of the loan down by about $100 per month, a significant savings for most people. The next big catalyst is Tesla insurance.
Okay, as Zach says, it's coming later this year. But I have to tell you, one of the thorniest things in the United States is car insurance, or insurance in general, because it's a state by state, and every state's got different rules and regulations. But our intent is to roll out nationwide and ultimately internationally. But there is a staggering amount of paperwork that is needed to get it done. But as Zach said, we expect to offer Tesla insurance in Florida later this year.
Elon and team have shared many times on earnings calls that they are focused on driving down the total cost of the vehicle, not just the sticker price. Many people forget how expensive gas, maintenance, and insurance is, but it can add up to a significant expense. So Tesla has set out to offer better insurance for cheaper, and they are well on their way to doing that. The problem is that Tesla insurance is only offered in 12 states at this time because each state has its own regulations and approval process. I currently live in Florida, which is obviously a massive state with a ton of Teslas, but we're still waiting for Tesla insurance to be offered here. CFO Zach Kirkhorn confirmed at the shareholder meeting that Florida will be able to offer Tesla insurance later this year, and I'm sure we'll see several other states added within the next 12 months. With every state that Tesla adds, it means more customers get to take advantage of the savings that Tesla insurance offers. Currently, the average insurance on a Tesla Model Y long range is about $3,057 per year, or about $255 per month, according to a recent article on ValuePenguin.com. That same article shows that the average monthly insurance payment for Tesla owners with a higher safety score is $99 per month, and it could even be as low as $74 per month for those with the highest safety scores. Not only is this a huge savings for customers, but it's another source of revenue and profit for Tesla. And the final catalyst for driving down Tesla's monthly payments in 2024 is Tesla's ability to offer longer financing options than it does today.
The vast majority of the financing is from banks. So it's kind of whatever the banks are prepared to do. I mean, this year, I guess we'll do on the order of $100 billion of sales. And we don't have $100 billion in cash to finance that. So the vast majority of it has got to come from banks. So it's really the bank's choice of what they're willing to do. It has been tricky with banks recently because, as I mentioned earlier, if you're a bank and you're not sure whether you're going to be alive or not, it's a pretty big distraction. And increasing your auto loan portfolio is very much a secondary priority. So it's just important to appreciate it's not up to Tesla, it's up to the banks.
We recently saw an example of this happening as Tesla Spain was offering financing terms for up to 10 years. This is actually a big deal because going from 6-year terms to 10-year terms cuts the monthly payment down by about $300 per month for a Model Y. I would assume that as interest rates begin to decrease and the stress on the banking system alleviates, a handful of banks will likely be open to taking on these longer financing terms. After all, from the bank's point of view, one of their biggest concerns will be the long-term residual value of the asset they are financing, and there are very few assets that hold their value like Teslas do, especially now that the price of a Tesla has dropped to the point that it's comparable to the average cost of a new vehicle sold in the US. A year from now, I expect every Model Y sold in the US to be using structural battery packs, 4680 cells, and come equipped with hardware 4 for FSD. Why wouldn't a bank feel confident offering 8 or 10-year loans on a product like that, which is set up so well to maintain or grow its value in the future? Seems like a no-brainer. And so even if Tesla is able to offer only 7 or 8-year terms instead of their typical 6 years, every year it takes about $70 to $90 off of the monthly payment if you're talking about a roughly $50,000 loan. So now that we have all 5 of these catalysts spelled out, let's take a look at how this adds up to affect the total numbers. Currently, a Model Y long range has a sticker price with destination fees of $51,880 on Tesla's US website. After a $4,500 down payment and with financing terms for 6 years at 5.59%, that comes out to $776 per month. You add in the typical insurance carrier that's non-Tesla insurance at $255 per month, and you get a monthly payment of $1,031. Now let's look at those 5 catalysts I mentioned earlier. I believe that Tesla can achieve economies of scale at Giga Texas and with 4680 that would enable them to drop the sticker price of the same Model Y by $3,000 next year without any negative effects on profitability. That takes the sticker price with destination fees down to $48,880. You will also see that the $7,500 IRA tax credit has now been added at the point of sale and taken off the loan amount, which helps tremendously. When you add that to the $4,500 down payment, that takes the financed amount down to $36,880, down $10,500 from where it is today. With Tesla's ability to offer new creative financing and lower interest rates due to falling inflation, it's not far-fetched to believe we can see an 8-year loan at 2.99% by this time next year. Notice that this isn't the full 10-year term that is already being offered in Spain, because I like to be a little conservative with my numbers, but it's still very different from where we are today. And lastly, let's say we are talking about a customer like me who is in the state of Florida, which currently doesn't offer Tesla insurance today, but will likely have it in place by this time next year. So I get to pay $99 per month to insure my Tesla instead of the $255 I'm paying right now. All of these changes equate to a whopping $500 difference in monthly payments, taking the average monthly payment from $1,031 per month to $531 per month. Think about how many more people can afford to buy a Model Y long range when the monthly payment has been cut in half. Even before you factor in the savings on gas and maintenance, these 5 catalysts take the monthly payment of a new Model Y below that of a used gas-powered vehicle today. Now, I know some of you will point out that some of this stuff isn't necessarily a savings from where it is today. The $7,500 tax credit already exists, and extending someone's loan terms from 6 years to 8 years actually costs them more in the long run, not less. That is true to a degree, but that isn't how the majority of people plan their budgets. As Elon pointed out in the opening, most people look at what they can afford on a monthly basis and they go based off of that. Cutting a monthly payment in half is extremely significant, and it fits the outlook of most people. And when you take into consideration that a made in Texas Tesla Model Y with over 300 miles of range, 4680 battery cells, structural packs, and hardware 4, it's the safest vehicle on the road, and it's likely to have all the hardware it needs to be a robo-taxi someday, then you aren't exactly asking customers, banks, or Tesla to take a massive risk on what I've presented here. It will be an exciting time for us as investors when these pieces start to fall into place over the next 12 months. And if that wasn't enough, we'll also be 12 months closer to a little factory in Mexico being up and running. You know, the one that already gave us a detailed plan on how they're going to halve the cost of the current Model 3 and Y platform. If Tesla is able to get the all-in monthly payment down to $500 for a Model Y, imagine what they'll be able to do with the next-gen vehicle. Exciting times ahead for sure. If you guys enjoyed today's video, please like, subscribe, and leave me a comment below. Also, if you want to see my last video, the top 25 catalysts for Tesla stock, click on the card in the corner or the link in the description. Thank you for watching.